Welcome to the Deep Dive, your direct line to being well-informed. Okay, so today, the financial world seems to be, well, holding its breath. It feels caught between two really powerful forces. You've got that recent bit of relief, from the US-China tariff truce, a positive sign, gave everyone a moment to exhale maybe, but then bam, all eyes are glued to this one number dropping this morning, the US Consumer Price Index, the CPI data. It really does feel like a massive tug of war.
Oh, it absolutely is a tug of war. And you're right, that truce, it did offer a sort of temporary floor, took some geopolitical jitters off the table, near term anyway. But the CPI data, that's the undisputed heavyweight here. It's the main catalyst, the thing that's going to set the market's direction, at least for now. Think of it like a coiled spring, just ready to snap based purely on that inflation number. And it's not just about a bit of wobble. It's about how the market, the core ideas, especially around Fed rate cuts, might get, well, violently reassessed.
Right, violently reassessed. So let's try and unpack this fractured rally idea we've been seeing globally, where some markets shoot up, others stumble. No clear trend. Asia's a perfect example. A real tale of two Asias, like you said before we started. Japan's Nikkei 225 surged, 2.23%, a fresh all-time high. A lot of that was the truce effect, plus this hope for U.S. rate cuts. Big names like SoftBank, Advantest saw huge gains.
Yeah, huge gains there. But then you look at India, and it's a totally different picture. Indian markets actually faltered. The Sensex dropped about 368 points, and the main reason, a pretty severe sell-off by foreign institutional investors, the FIIs. They yanked almost 18,000 crore rupees out of Indian stocks just in August. And that seems directly linked to escalating U.S. tariffs on Indian goods, which have doubled now to 50%. Just shows how fragmented global risk feeling is right now.
Wow, doubled. Okay. And turning to Europe, bourses open a bit higher, the S2XX 600 up maybe 0.2%, but you said the rally felt fragile.
Fragile is the word. Germany's DAX, for instance, was lagging behind. And maybe more worrying, the UK market is still seeing this structural investor exodus. It's not just a blip. Money is consistently leaving. We're talking over £50 billion gone from UK equity funds since 2020. That points to a really deep lack of confidence, underlining that fragmented picture you mentioned.
£50 billion. That's quite something. Okay, let's pivot to the U.S. equity futures that are stuck in what's being called an exceptionally tight range.
Yeah.
Just pure caution. Everyone's just waiting. 8:30 versus AMET for that CPI number.
Exactly. And this brings up an interesting, well, maybe a disconnect. Between the equity markets and the bond markets, stocks are clearly nervous, right? But the U.S. Treasury market is telling a different story. You've got the 10-year yield at 4.28%, the 2-year at 3.76%. That gives a positive spread, about 51 basis points. Now, this upward sloping yield curve, that's usually a sign bond folks are betting on continued economic growth, the soft landing scenario. It's a real vote of confidence, kind of clashing with the stock market anxiety.
Interesting contrast. So what are people actually expecting for the CPI number? The consensus forecasts looks like month-over-month headline inflation at plus 0.3% and core CPI, stripping out food and energy, at plus 0.2%.
Those are the numbers. But the stakes here are incredibly high. Right now, money markets, they're pricing in more than 2 Fed rate cuts by December. That's pretty dovish, expecting the Fed to ease up quite a bit. If that CPI number comes in hot, higher than expected, it could just tear through those expectations. A rapid, maybe painful repricing. It could really pull the rug out from under any recovery hopes.
Pull the rug out. Yeah, okay. So the Fed's move is key. But what if some of this inflation pressure isn't just policy? What if it's more structural? Because, interestingly, the NFIB Small Business Optimism Index just ticked up to 100.3. Good news, right? But buried in there was this detail. Labor quality jumped back up as the single biggest problem for owners. A third of them can't fill job openings. That's not just small business chatter. That screams persistent wage pressure, doesn't it? Something the Fed can't just ignore.
That's a really important point. And these big macro trends, they're not just numbers on a screen. They force real changes in how companies operate. Think about geopolitics, tech shifts. Look at NVIDIA and AMD. There are reports they've agreed to give the U.S. government 15% of revenues from chips sold into China just to get export licenses. That's unprecedented. A whole new kind of risk for shareholders, having revenue tied to government approval like that.
15%, wow. And on the flip side of risk, you see AI becoming really practical, right? Not just hype. Like RadNet, the big imaging center company, they just spent nearly $29 million to buy C-Mode Technologies. That's an AI firm focused on ultrasound analysis. And RadNet's goal, boost efficiency, maybe cut scan times by up to 30%. That's AI having a real, tangible, bottom line impact.
Absolutely, tangible benefits. So putting it all together, the market really is in a state of, let's call it suspended animation, a holding pattern. That U.S.-China truce offered a bit of a shaky floor, sure, but the CPI report, that's the decider for today, no doubt about it.
The decisive moment. So thinking about all this, the mixed signals, the global fractures, the tech shifts, the policy pressures, what does it all mean for you? How are you going to read the tea leaves after this critical inflation test lands? Lots to consider.